think investors need to ask themselves, like, what is a fair price to pay for future earnings, and what is kind of viable going forward?
So I was watching Stanley Druckenmiller this morning on Bloomberg, and he mentioned his time at Soros and how he was absolutely right, but not in time. And he had a $200 million bet that ended up costing him $600 million in because he was short. And the market can run longer than we can be right. In a lot of cases, and nothing points more to this than like back to 1999 and 2000, when I kind of was first cutting my teeth in New York. There was all that hype, and there was a lot of change, and there was a lot of things that were happening. And as time went on, of course, everything got better. But there was a lot of companies that blew up, and I kind of feel like since then to now, there's been so much stimulus in the marketplace with so much money chasing all this stuff that people don't remember the time before that, which was when fundamentals mattered. And I still feel like fundamentals should matter. And I don't know when they're going to revert to where they do matter. Do you guys have any thoughts on that process?
I do. So I don't know if 99 is the best proxy. I think for the Nasdaq in aggregate, it's comprised of arguably the best, most profitable companies the world has ever seen. Whereas back then, it was mainly comprised of unprofitable companies without a clear direction to profitability. I think the ARK fund is actually a better proxy for what happened in '99. And interestingly, if you were to take the Nasdaq back when it peaked to trough, it was down 80%, and that's about what ARK was down. And it's also important to note that the ARK fund peaked in February of 2021.
Mm-hmm.
So there's been a lot of things kind of going under the hood of the market, and with tech in particular. So there are some similarities to 99. However, I think the companies that make up what we'll call the Magnificent Seven are phenomenal companies. They're just trading at really high valuations historically. It's also interesting, even if you take, like, let's just say Apple's market cap, it's bigger than the entire London FTSE in aggregate. It's bigger than the entire Paris CAC in aggregate, and it's bigger than the entire German DAX in aggregate. It's also bigger than the Russell 2000. So the trees can't grow to the sky, right? And so
Sure.
Apple approaching on a 3 trillion market cap, I think investors need to ask themselves, like, what is a fair price to pay for future earnings, and what is kind of viable going forward? And Apple trading at 30 times forward with negative year-over-year earnings, that's tough to make sense of.
Yeah, I think that the Nifty 50 from back in the 70s is another kind of good comparison, as there were a number of companies at that time where people, I mean, they were called one decision stocks. You just had to buy them and hold them forever, right? Xerox was one of them, right? But they were a great innovator in the 70s, and then they lost that kind of innovation bug, and now it doesn't really exist. And so there were a number of companies at that time frame that people viewed as being, the next driver of innovation and the future of society, and that was true for a period of time. And then the market kind of evolves, and things happen, and some of the incumbents adopt some of these technologies. Some new players come in, so it's just hard to, I think, over the longer term, assume that these 12 companies are going to continue to dominate the market forever. However, I don't know what's going to happen to prevent them from dominating them for the foreseeable future. So it's hard to come up with like the counter argument at this point.
Hey, thanks for watching The Merge. We've got a ton more stuff for you to watch on YouTube, on Instagram, on TikTok, everywhere. Check us out.